Bonds, inflation, and your family's wealth. A historical study of how crisis affects economics viewed primarily through bonds and inflation. We've got a lot to cover, so let's get started. So what is a bond? A bond is primarily a debt instrument. It's how governments and institutions borrow money. In black, we have the U.S. 10-year Treasury bond yield. It can be used to indicate the midterm health of the economy, right? And in blue, we have the federal funds rate. It's the overnight rate banks use to lend each other money. It's set by the Federal Reserve, and it's the main tool the Fed has to combat crisis, right? And so what's going on here in the early 60s period, right? We've got black over blue, and that makes sense. If you borrow $100 from somebody overnight, you can expect to pay a point or two. But if you borrow $100 for 10 years, you can expect to pay a little bit more. Now let's talk about what led into this early 60s period. This period is the end of the post-World War II recovery and rebuilding period. World War II ended in 1945, and soon after, the U.S. experienced significant economic growth domestically and internationally. The US dollar is still pegged to gold at this time. The middle class is expanding. There's an increase in consumer spending and demand for goods and services. Companies' profits are increasing. The war efforts have refined the industrial revolutionary processes and applied them to every industry from manufacturing to transportation and infrastructure. So what does this mean? Jobs, refrigerators, microwaves, televisions, automobiles, homes, a strong economy. The U.S. has made some heavy moves to increase its global influence. The Cold War began in 1947 and is a major source of civil and social strife globally. The Korean War has come and went. The Vietnam War is still raging at this point. The U.S. has been making moves in Africa, Eastern Europe, Middle East, and Asia. Also, at this time, we see a massive increase in the media and crisis and propaganda dissemination machines due to new communication inventions like radios and TV. The fear economy is front and center, or rather, it has the potential to be front and center. Now, let's go back to our chart, right? So as we move through the 60s, the 80s, right, we see the federal funds rate, the overnight rate, spiking over the 10-year yield repeatedly, right? And what's going on here, right? I'll tell you. Inflation, unemployment, oil embargoes, right? Conflicts in Latin America, Africa, the Middle East, proxy wars with the Soviet Union. We have the moon landing in 1969. We come off the gold standard in 1971. Oil crisis, inflation, unemployment, proxy wars, women's and civil rights movements. Crisis is front and center in the U.S. economy, and it's ripe in the investor's mind. There's lines at the gas station, shortages at the grocery store, high inflation. Until August 1979, Paul Volcker becomes the Federal Reserve chairman. And a lot of lessons are learned from this period. We can see a rapid rise multiple times of the federal funds rate. And we see that to combat inflation in red here, the Federal Reserve must maintain the federal funds rate over the rate of inflation for a prolonged period of time. Let me show you a little more. Boom, once they've done this, inflation has come back down. But as we still go through time, we can see how sensitive investors and the Federal Reserve are to random spikes of crisis, right? Inflation is not the only crisis that exists. Investors just spent an entire 15-year period with rampant crisis, and they do not want to get caught with their pants down again. Then, as the Cold War comes to an end in 1990, 1999, we see a massive relaxation of the economy. Massive, right? You could just take a look at what was going on, the hectic nature of what was going on here, and the soothing nature that comes into the 1990s period, right? We actually saw a slight recession in the early 90s. Slight recession, maybe 18 months. And this could be seen as the economy and the Federal Reserve adjusting to the new rates of crisis, right? But overall, the 80s and the 90s were great for business. Bill Clinton is the president. There's low debt. There's a surplus of the government's funds, and we are mostly back to black over blue. So everything's great. Then, at the turn of the century, we have the dot-com bubble. It bursts. Crisis once again in the markets. Crisis in the banking system. Crisis. Then again, and the Federal Reserve must drop its rates to help stimulate the economy. Then again, in 2008, we see a massive dump in the federal funds rate. But generally, the midterm outlook on the economy is pretty solid, pretty flat. Let me return momentarily. With the dot-com bubble, we see the Federal Reserve do something it has almost never done before, right? It rapidly decreases its rates to zero and near zero positions. And they do this to stimulate the economy. After some time, they try to raise the interest rates back to more normal levels. And once again, with the '08 banking crisis, they're forced to drop rates again. And they stayed there for a prolonged period of time. Up until 2017, 2018, we had zero and near zero rates. In the 2017-2018 period, they moved to raise interest rates again, and the market did not like it. The economy did not like it at all. And so they're forced to drop rates again to zero due to COVID. Well, not only due to COVID, they were headed there to begin with. But after COVID, we see a sharp spike in both the 10-year yield and the federal funds rate. And now that the Fed is battling with inflation, we see them having to revert to a policy of rapidly increasing the federal funds rate. Now let me show you how bonds fared against inflation. In black, again, we have the 10-year Treasury bond yield, and in red, we have the inflation rate. Early 60s period, everything's fine. In the 70s, we see spikes of inflation, and we see the 10-year Treasury bond yield slowly creeping higher and then more vigorously moving higher. Right around here, we see the Volcker period, and he kills off inflation. We also see the sensitivity of the markets to random fits of crisis. We see the deep relaxation of the post-Cold War period. Very interestingly here, the dot-com bubble does not have much impact on the 10-year Treasury bond yield. Right? Investors were not shaken very hard by the dot-com bubble. And again, in the '08 financial crisis, we did not see much discomfort due to the financial disaster. But we are shown what a liquidity and credit crunch and a lockup does to inflation. It causes inflation to drop below zero. But ultimately, everything stays fairly calm in the midterm outlook for the economy until COVID, right? We saw both inflation spike and the U.S. 10-year Treasury midterm market outlook get a little crazy. Just to reiterate, here's the federal funds rate in blue and inflation in red. We can see the 60s and the 70s period where the Federal Reserve was chasing inflation and chasing crisis and dealing with it as best they can. We see the Volcker period. We see the sensitivities. We see the end of the Cold War. We see the dot-com bubble. We see the '08 financial crisis and the credit freeze. And finally, we see the prolonged zero rates. We see the failed attempt to increase interest rates. We see the post-COVID and the post-inflation spike actions of the Federal Reserve. So, what does this all mean? I'm personally a younger millennial, but everyone from the tail end of Gen X to Gen Z is likely to inherit a substantial amount of money. So what should we do, right? We should expect the crisis economy to return. And we should expect the same thing as the past. Rampant inflation, fits of unemployment, war and rumors of war, and expect times of social unrest. Just like our forefathers. And we should take measures to prepare against shortages, stock up on sales, stock up on cheap food, get in shape and become self-disciplined. Eat less, cut out junk, and figure out how to increase your income. Get creative, invest in yourself, master your skills, start a business. This is an important time to preserve and increase your income, right? And what should we do on the asset side of things, on the investing side of things? We should focus on asset selection. Buy what you know. No random investing. No investing in random ass companies and industries you don't understand. Know when to buy. The money is made when you buy. Bitcoin, for example, reached $69,000. But if you bought at $55,000, and you didn't sell the top, you're underwater right now. But if you had bought, at the COVID lows, you would have more than doubled your money if you had gotten out in time, and you would just be, slightly underwater now. So when you buy is extremely important. Watch out for the shiny new bullshit schemes that come out every day. And finally, and likely one of the most important things, no more index investing. It is totally preposterous for people to move and live and apply their money on the assumption that they're going to get a sustained 10% on an asset investment. These times reward smart individual stock pickers. Finally, beware of the marketing and propaganda machine. Stay calm, stay composed, stick to your mission, right? Get in shape. Thank you very much. Thank you for watching my video.